Let's hit the record button. The best point of departure will be for us to start with question 3.1. Question 3.1 in your textbooks. Okay, so let me quickly share my screen with you guys, and then we can then get into that. Okay, there we go. All right, so now you should be able to see my screen. Let's shift over to you guys' stuff. Okay, and there we have it. Question 3.1. Okay, right. So let's start with what is required. What do they want us to actually do over there? Okay. I actually forgot to greet you guys. I hope you're all well. Just give me a thumbs up or a smiley in the chat. Just want to know that you guys can hear me loud and clearly. Okay. Right. Thank you, Marcus. Thank you, Ayanda. Thank you, Adrini. Okay. Okay. So, like I said, we're doing question 3.1, okay? And there under the required, it says, calculate the markup percentage applied to Benmore traders, okay? Markup percentage, they want us to calculate markup percentage firstly, then secondly, calculate the corresponding gross profit percentage, okay? Then they go on to say, complete the two scheduled budgets by filling in the missing figures. All right, they want us to do the two scheduled budgets. All right, that would be for your debtors and that of your creditors. Okay, and then they also want us to do lastly, there's an obvious risk of falling into a debt trap if the debtor's collection period is extended whilst keeping the creditor's statement period constant. Will the business be making themselves guilty of overtrading though? Motivate your answer. Okay, motivate your answer. Okay, so we'll look into that a bit later. Let's get into the first bit. Okay, and the first bit I've done for you. Okay, you guys should remember this from your accounting days, where we would say, I want to quickly draw up the markup percentage formula and that of the gross profit percentage. So remember, for markup, it was profit over cost. And then for gross profit percentage, the formula is profit over selling price. Okay, right. So if we look at our table, or before we go there, let's read the top information there. It says Benmore traders used to have a debtors collection period as well as a creditor statement period of 30 days. The financial manager has provided the following two incomplete budgets to help her with a very important decision: whether or not the debtors collection period should be extended to 60 days in order to boost sales revenue, or whether to keep the collection period constant at 30 days. Okay, so that's the situation right there. Okay, then if we look there under scenario 1, it says keeping the collection period constant, causing no change in sales. Okay, abbreviated statement of comprehensive income. There we've got our sales, and then cost of sales, and then our gross profit. Okay. Right. No problem. So first things first, what we need to do is in both of these formulas, we need to get profit first. Okay, so if we look there in the table, you can see, and here when we're talking profit, we're talking gross profit, not profit. Okay, so maybe I should actually write that. Gross profit. Okay, so in order to do that, what do we need to do? We need to take our sales revenue, which is at 176,000. Okay, I'm looking at the March column, all right, 2008. Okay, and then we need to take our cost of sales, okay, and deduct that from the revenue, and then we get our gross profit. Okay, now that we have our gross profit, then we can work out the first one, which is your markup. All right, gross profit divided by cost of sales, or cost. Okay, so we take that 87,500 divided by 87,500, because that's our gross profit and that's our cost, and times it by 100, and we get 100%. Okay, so that's our markup percentage. Then we go over to calculate our gross profit percentage. Our gross profit percentage is our gross profit divided by our sales, or selling price. Okay, and our sales is 175,000. Okay, and that gives us 50%. Okay, so we finished part 1 and part 2 already. All right, we've done that. All right, then it's time to then do the calculations for the scenarios. Okay, for the 2 scenarios. So what we must then do, okay, what we must then do is, first things first, we have to deal it, we need to deal with it month by month. Okay, so here we already calculated the gross profit, and that was 87,500. Okay, after we've calculated that, we then find out, if you look in the table there, you see that expenses paid in cash has already been filled. We already have that 32,000. Okay, so then we can calculate our net profit. So let's do that. Let's do that. 87,500 minus 32,000. What does that give us? 55,500. So now we have our net profit, 55,500. Okay. All right. Now, over here is what we then call our bank balance. Okay. So we want to find out actually how much cash do we have. All right, at the end of the month, our closing balance for the month. That's what we are working towards with this section. Let me highlight it. That's what we're working towards. We want to find out what is our closing balance for the month. Okay, we know that our opening balance, what we started with at the beginning of the month, was 200,000. Okay, movements during the month, that's what are the expenses that we incurred. All right, what are the expenses that we incurred during the course of the month? Okay, right. So did we miss out on any additional information? Let's just see there quickly. Under the second scenario, it says, note that all merchandise is purchased on credit and sold within the same month. There were no outstanding amounts from debtors on 1 March 2008. Okay, no outstanding amounts in March 2008. Okay, cool. All right, so now that we have that information, remember what they said? They said all merchandise purchased on credit. Okay, right, that's fine. So then what we then go on to do is we then go and we see, okay, there's 200,000 there. Then we see, okay, expenses paid in cash. We already have that amount. Okay, they've already given that to us, 32,000. So we just repopulate that. Okay. All right. And then here, in terms of settling the creditors, okay, it doesn't say that we purchased anything. So there you can then put 0. You can then put 0 over here. All right. And then over here, we can also put 0. Okay, because we didn't receive any cash from debtors. Okay. And if you look there in the sales column, for March, you can see all on credit. Okay, so that means everything that this sales, can you see? I'm gonna highlight it in green. You can see there it says all on credit. Okay, right. But there was nothing. Again, what does it say there? Under additional information, it says no outstanding amounts from debtors on 1 March. Okay, so for the month of March, it's 0 under cash receipts from debtors. All right, we didn't receive anything. So then the total on the movements is then going to just be this 32,000. Okay. So that's why we work out all this stuff in yellow to get the total on the movements. When we now have the total on the movements, then we can deduct the total on the movements from the 200,000. Okay, and somebody tell me in the chat there, how much is 200,000 minus 32,000? Someone tell me there in the chat, 200,000 minus 32,000. Yes, 168,000. Okay. So here we have 168,000. Okay, and that's a positive because 200,000 is obviously greater. Okay, once we have that, the closing balance that you have over here, and I'll put this blue, light blue, the closing balance that you have over here becomes the opening balance for the next month. Okay, can you see that? All right, so here, what are you going to get? You're going to get 168,000 as your opening balance for April. Okay, but then here also, we still need to first work out this and get our net profit. All right, so if you look there, they've given us all these amounts. All right, that hasn't changed. Our sales hasn't changed. So this is going to be 87,500 as well. Okay. Okay, so then the profit is obviously going to be 55,500. Okay, we might as well just calculate this now. It's going to be 87,500 as well. Profit 55,500. 87,500. 55,500. Okay, right. So now we have this net profit. Okay, again, so expenses paid in cash is going to be the same because that's the same throughout. So we can even do that as well right now. Let me even just copy and paste. Okay, we pasted that. That's fine. So then we ask ourselves, okay, remember what they said about creditors. They said a note or merchandise is purchased on credit and sold within the same month. Okay, and sold within the same month. And when we look up top there, it says that Then more traders used to have a debtors collection period as well as a creditors settlement period of 30 days. Okay, so if it has a settlement period of 30 days, okay, what that means is that all the goods that we have bought, all right, which is your cost of sales, okay, from this month of March is getting paid 30 days later, all right? In other words, it's settled in April, okay? I'm coming down here, and then I'm saying creditor settlement in cash, okay? So we're gonna put that 87,500 from the previous month, okay? Right, so we've put that in there. Then cash receipts for debtors is also settled in 30 days, okay? So all of these sales is 175, so that's obviously going to be 175. All of that is on credit. Usually they'll tell you a percentage of it is on credit, okay? And when they do that, that means that you then have to apportion it for that percentage. Okay, so somebody tell me then, what is the total on our movement, which we know is this total here? What's the total there for our movement during the month of April? What is the total there? Somebody tell me there in the chat. What is the total movement for the month of April? Total movement for the month of April. Okay, let's see what you guys are saying. I want to get the movement first before we get the closing balance. Okay, 55,000, 55,000. Is that correct? Yes, that is correct. Now that we have the movement, we can now work out the closing balance. Okay, so that's a positive 55,000. Okay, so now what is the closing balance? Okay, the closing balance is obviously the opening balance plus the movement. What do we get as the opening balance? What do we get as the opening balance? 223,000. 223,500. I get 223,500. Okay, thank you, Miss Megan. Okay, so I think you just missed the 500 there, Gianni. Okay, so 223,500. Okay, right. Let's see. Got people saying there in the chat. Oh, no, no problem, no problem. Right, so again, this closing balance becomes our opening balance for the next month. So we can copy and paste that over there. And then we do the exact same thing here under our creditors settled in cash. Remember, there's a 30. So what we took out, cost of sales, is that's pretty much our purchases from the previous month. Okay, so now we take that and we're gonna say 87,500 brackets. How much did we sell? We sold the same amount, 175,000. Okay. So then our movement is also going to be the same. It's going to be 55,500. Okay, but this time plus the 23. sorry, the 223. So let's add that up. 500. And we get 279. So 279,000. Okay, we're going to get the same exact numbers because here we got the same exact cost of sales, which is our purchases. We have the same, what's this? Expenses in paid in cash, and we also have the same, what? We have the same sales revenue, all right? So again, let's just copy and paste this. Okay, and the revenue. Okay, so then obviously our movement is still the same. 500. Okay, so then here our opening balance, remember we said it's the closing balance from the previous month. Okay, so 55,000 plus this 279. 55,500, almost forgot that. 1, 2, there we go. 334. So hey, our bank balance is increasing. 500. There we go. So that is scenario 1. Okay. Then we move on to scenario 2. Increasing the collection period, causing a rise in expected sales. Okay. Why is there a rise in expected sales? Somebody tell me, why is there a rise in expected sales by increasing our collection period? Why is there a rise? Anybody want to give it a go? Okay, whilst you guys think about it, let us proceed. Let us proceed. Okay. Cool. So here they haven't given us cost of sales, eh? They haven't given us cost of sales, but so we need to work our way backwards now to what is cost of sales. Okay. So we then say 175,000 minus 875. Okay, we get 87,500. So I think here we can just work these out first before moving forward. Okay. Oh, thank you very much, Siabonga. Thank you for that. Okay, then here we're saying 190 minus 95. What do we get, guys? That should give us 95. Okay, I'm just doing that mentally. And here 220 minus 110, that should give us 110,000 cost of sales. Then here 368,000 minus 184. Okay, I don't think I'll be able to do that one mentally, but judging from their habit, I'm sure that's going to be 184 as well. Yeah. 184,000. Okay, so there we go. We have our cost of sales. Okay, we have our what do you call it? Expenses paid in cash. That didn't change. They've kept it the same. Our net profit is obviously going to change. Here we know it's going to be 55,500. Okay, because that's what we were getting the last time. Okay, right. So first, let's finish off. Okay, actually, we can just do this now. So let's quickly do that. Let's just knock out this net profit. So 95 minus 32. We get 63,000. Okay, then 110 minus 32. We get 78,000. Okay, then finally here we have 184 minus 32. We get 152,000. Okay, awesome stuff. All right, so we have the net profits for all of them. Now we can get into this. All right, 32,000. Again, we know what this is for all of them. So we can just do that. Okay. And okay, we have that for all of them. All right. So what are they saying here? Remember, in the second scenario, they're saying increasing the collection period, causing a rise in expected sales. Okay, remember I asked you guys why that is the case. So remember, if we read the top, they said debtors collection period should be extended to 60 days. All right, should be extended to 60 days. Okay, so here, remember what we were doing when it was extended, when it was 30 days, we're saying, okay, we get the cash back the month after. So if that's the case, all right, so obviously here we're not going to be paying anything, as was the case. So here we're not paying anything, but here it's going to be remaining the same. Okay, remember cost of sales is our purchases. So here, because it's 100%, all right, so 87, it's going to be 87,500 as it was the last time. Those brackets. So I can, okay, it's not the same. So then we have to do it again here. Okay, this time it's 95,000. And here it is 110. 110. There we go. All right. So we finished with our creditor settlement in cash. Remember, it's a 30-day for settling our creditors. Okay, 30 days. In other words, the next month, 110. Okay. All right. There we go. So now we need to do the debtors. Okay, we know the first month we're not receiving anything. Second month, again, we're not receiving anything because it's 60 days. Only in this month do we receive 175,000. Okay, because all of the sales is on credit. Okay, so I'll put that in light blue. Then here it's 190,000. Okay, we've done it. Okay, now we need to calculate the movements. Here we know it's just going to be negative 32,000. Okay, so this 200,000 minus the 32. Remember here we calculated 168,000. Okay, this closing balance again, I'm going to highlight it in green, is the opening balance for the next month. Okay, so here we're going to put 168,000. Okay, done. Then we need to calculate the movements. Okay, so 32,000 plus 82,000, sorry, 87,000. Let's do it on the screen. 32,000 plus 87,500. We get 119,500. So here it's a negative 119,500. Okay, so then what is our closing? Let's see, I'm going to say that minus 186. 1, 2, 3. What do we get? 48,500. 48,500. Okay, so we're still positive. And here we carry that to be our opening for the next month. 500. Okay, what is the total movement? Okay, let's see. So here we have 175 minus 32,000, okay, minus 95. Okay, we get 48. Okay, so the total movement here is 48, a positive 48,000. Okay, so that positive 48,000 plus a positive 48,500. What does that give us? Let's see. Plus 48.5. You get 96.5. 96,500 in other words. Okay, we've got that. So then here, this is going to be our opening balance, 96,500. Okay, what is the total movement here? So it's 190 minus 142,000. See what we come up with over here. Okay. Just charging my device. So let's see here. 190 minus 142, get 48. Okay, so 48,000 plus 96,500. Plus 96.5. Okay, 144,500. Okay, all right, cool. So we're actually done now. We have our closing balances for every month. This closing balance again will be the opening balance for July. Okay, we've calculated everything. All right. Now, I asked you guys a question earlier. I don't know if anybody answered there in the chat. Why does increasing our collection period for our debtors increase our sales, total sales revenue? Why? And you can switch on your mic to answer. It's more than welcomed. Nobody wants to answer. Okay. All right. So I'll tell you, the fact that we've extended our credit period, all right, means that people can pay back in 2 months as opposed to in 1 month. What then does is it means that people can take longer to pay. So in other words, they have more time to pay back the money they owe us. And in allowing them more time to pay back the money they owe us, that obviously puts them in a position where they can take on more because they know they have more time to pay it back. All right, so that's why our sales increase, as you can see here, from 100. Remember, every month we're doing 175, but now we did, in the next month we did 190. The month after that we did 220. The month after that 368. Okay, so that is why the sales increased, because now people have more time to pay back the money. Okay, then the next question that they had, all right, the last thing. Okay, remember we have scenario A and we have scenario B. Okay, or scenario 2 and scenario 1. And what they were saying is that they were asking the question, should we increase our debtors collection period, all right, to 60 days when we know that our creditors collection period is going to remain 30 days? Remember here, can you see the creditors collection period? When we had to settle that which we bought on credit, all right, hasn't changed, still stayed the same. After 30 days, we have to pay our creditors back. All right, so we're saying, should we actually increase our debtors when we're not going to increase our creditors settlement period? And so what then happens is that we look and we say, are we profitable? Is our closing balance positive or in negative? Okay. So here, if you look, our closing balances are bigger when we have a 30-day collection period for our debtors, okay? And also here, you can see it's smaller, all right? But the fact of the matter is it's still positive, all right? So if it's still positive, they can still take on the risk. They can justify taking on the risk of actually extending the period for which debtors have to pay us back, all right? Okay, cool. Right. So, guys, I think let's just take a quick breather and then we'll get back together in 10 minutes. So if we can get back together, let me say at 2:05, then we'll tackle question 3.2 and then we'll see how much time we have left. If we have some more time, then we'll do question 3.5 and that'll be our unit 3 completed. Okay, so yeah, let's take a quick 10-minute break and then we will proceed with question 3.2. If you have any questions on anything we've done so far, please feel free to throw your question in the chat and then we'll address it thereafter as soon as we get back together.